Workhorse lost out on the U.S. Postal Service bid for the EV revamp of the entire U.S. postal truck fleet to Oshkosh. By the way, also, there's a chance that Ford is going to be making the motors for the Oshkosh vehicles for the U.S. Postal Service, so yay, Ford investment. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of March 1st, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. That week sucked. For the second week in a row, it probably seemed like the sky was falling and the bottom was falling out of your portfolio. By the weekend, we had the NASDAQ down 5% off of its highs, the S&P dropped by another 74 points, and the Dow Jones was actually down 550 points. There's actually a pretty good reason for all of the drops. We're going to go ahead and cover that with the news today. So let's get into it. Before we get started, I do post all of my technical analysis online every week. The link is below the video. This isn't the greatest technical analysis, but it is my practice. I'm currently covering 11 companies and I added in KBNT this week after my DD video last week. Please remember also, this is not indicative of all of my holdings. These are simply the companies that I do want to follow the TA on. First news story, let's talk about the press conference with Jerome Powell and the Fed. This is from a Bloomberg article. Fed views rising yields as a bullish sign reflecting 2021 optimism. Once again, I'm paywalled through Bloomberg, so we're going to take a look at this on Reddit. Somebody was kind enough to post the text from the story into Reddit. Free sharing of information. I love it. James Bullard said, I think the rise in yields is probably a good sign so far because it does reflect a better outlook for the U.S. economic growth and inflation expectations, which are closer to the committee's inflation target. When we talk about rise in yields, we're talking about the interest rates, the percents on the U.S. Treasury yields. They go on to stress that the Fed's goals are full employment and price stability, and that the central bank is going to maintain ultra easy monetary policy for some time. There's optimism in the strength of recovery. GDP growth this year could be the strongest we've seen in decades, though he added the underlying inflation is likely to remain subdued for some time. Bullard said U.S. unemployment is going to drop to 4.5% by year's end, and there's going to be elevated savings that are going to boost spending at that point by Americans. The key takeaway here is right at the end, though. Just to remind you, our mandate is full employment, not full GDP. It's not the size of the GDP. This disparity is something that's important and something we're going to have to continue to watch closely. The 10-year Treasury yield jumps to a one-year high of 1.6%. The move in higher rates is unnerving investors, fearing that it could be driven by inflation instead of economic recovery. You can see here that we are hitting 1.6% for the first time since February 1st, 2020, before the COVID crash really hit the American markets. Rising Treasury yields are typically a sign of a healthy economy, of economic recovery and subsequent economic activity. We know that interest rates are still low, and a lot of people are wondering, why are Treasury yields rising then? Economically, there's an inverse relationship between Treasury yields and bond interest. Typically, if bond interest is increasing, Treasury yields decrease, and vice versa. If bond interest is decreasing, Treasury yields increase. We ended up seeing this in the markets. If you take a look on Friday, we had a massive sell-off of bonds, and what this means is they're most likely fleeing bonds to go to an equity class or to go to an investment that's going to yield higher returns for them. Maybe they were in bonds as a hedge, but with this announcement from the Fed, there's not going to be any point in being in bonds right now because the interest rates are going to stay low. This just happened on Saturday evening. The House passes Biden's $1.9 trillion COVID relief package. Yay, it's over. We're getting our checks. Not so fast. If you're not American, you might not know this, and if you are American, you might forget this. This doesn't mean it's going to happen. The bill passed the House, and now it has to go on to the Senate. Making the effort more complicated, the Senate is expected to strip out a provision in the legislation increasing the federal minimum wage after the Senate parliamentarian ruled against including it under the procedure known as reconciliation, which Senate Democrats are using to pass the bill with a simple majority vote. The bill would then have to go back to the the House for a separate vote before it could go to Biden to be signed into law. Because of the $15 minimum wage stipulation in the recovery bill, that's going to get stripped out in the Senate, and it's going to go back to Congress for another wave, where it's probably going to get approved at that point, or we might have more deliberations to include a federal minimum wage hike of some sorts, and this might be delayed even further. So put your party hats away for now. This isn't necessarily happening immediately. More than 150 CEOs urge Congress to pass Biden's COVID relief package. Notable signatories include Goldman Sachs' David Solomon, BlackRock's Larry Fink, Deutsche Bank's America's Christiana Riley, and Blackstone's Steven Schwartzman. This kind of sounds notable as soon as you hear it, because you're thinking, oh wow, even the CEOs are supporting this economic stimulus package. But think about it. The Democrats control Congress. We have a Democratic majority Senate with Kamala Harris as the tiebreaker. We have a Democratic president. These CEOs urging Congress to pass a Democratic legislation so it gets to a Democratic executory. This is basically lip service. Congress needs no urging to pass this bill. It's most likely what they want anyway. And it makes the CEOs look like people, since there's the federal minimum wage increase in there and a lot of provisions for small businesses. Friday, after market close, Berkshire Hathaway reported their earnings, and Warren Buffett bet on America in his annual letter. Berkshire Hathaway reported a Q4 2020 results. Earnings per share, $23,000.15. This is for the Class A shares. Berkshire Hathaway has Class A and Class B. Class B is for the poors like us. EPS were up 28.5% year over year. They beat consensus estimates by 42%. Net investment gains, $30.8 billion. They beat the estimate of $30.1 billion by 2.3%. I don't know why, but people are betting against Warren Buffett and saying, oh, has he lost his edge? He's 90 years old. Let this put it to rest. Warren Buffett, even with the mistake in the airlines last year, has not lost his edge. He's still got it. He's still one of the greatest investors of all time. One more notable here is the share repurchase. Last year, we demonstrated our enthusiasm for Berkshire's spread of properties by repurchasing the equivalent of 81,000 A shares, spending $24.7 billion in the process. That action increased your ownership in all of Berkshire's businesses by 5.2% without requiring you to so much as touch your wallet. What exactly is a share repurchase? Because a lot of times the government will have you think that it's bad, but from a business standpoint, it's often good. So a share repurchase is a transaction whereby a company buys back its own shares from the marketplace. Keynote here, these happen at market value. A company might buy back its shares because management considers them undervalued. The company buys shares directly from the market or offers its shareholders the option of tendering their shares directly to the company at a fixed price. So this might happen for a company to boost the value of its own stock, improve its financial statements. Companies tend to repurchase shares when they have cash on hand and the stock market is in a general upswing. Companies can do share buybacks just like we buy shares. If they think their own company's shares are undervalued, which they know better than any of us, then they can buy back their own shares and make money as the share price increases. When a company buys back its own shares, it increases the value of the shares twofold. One, because there's a transaction wherein it's buying and raising the price, and two, it's taking the shares off the available market, decreasing the overall supply. Domino's Pizza also reported its earnings this week. Its earnings were not nearly so positive. Its earnings per share was $3.46 adjusted versus $3.89 expected, and its revenue was $1.36 billion versus $1.39 billion expected. The reason that I'm pointing this out to you is because a day before their earnings report, Domino's board reauthorized a $1 billion stock buyback venture. This is most likely because Domino's knew their earnings report wasn't that great, but it still has high hopes for its company in the future. So it was buying back the shares, which generates excitement, which keeps the stock price from lowering during the bad earnings report. So this was kind of like a bet on themselves, a bet on their future. This is just a really cool strategic move by a business to make. Also reporting earnings this week was Rocket. You guys know how much I love Rocket. Rocket companies experienced explosive growth. Revenue increases 144% year over year to $4.7 billion in the fourth quarter. Company announces special dividend of $1.11 per Class A share of common stock. These numbers in the Rocket earnings report are like an investor's wet dream. So they had increased adjusted revenue to $4.8 billion. They grew their net income 277% year over year. Their increased adjusted net income is is up 350% year over year. Before I talked about what an efficient company Rocket is, check this out. They increased their gain on sales margin by 100 basis points year over year to 4.41%. They've actually become more efficient in their business in terms of margin. Our 2021 Super Bowl ads featuring Tracy Morgan, Liza Koshy, Joey Bosa, and Dave Bautista were ranked #1 and #2 by USA Today's ad meter. Definitely important to keep in the earnings report. We remain in a strong liquidity position with a total liquidity of $7.7 billion. So what's the company doing with all this cash on hand? Before I read this, it's really important to realize that Rocket has been range bound between like $19 and $24 for like months now. They are one of the most heavily shorted companies on the US market. The management has come up with an absolutely ingenious way to finally break out of that shorted channel that they've been stuck in. Our company's board of directors declared a special dividend of $1.11 per share payable on March 23rd to holders of our Class A common stock at the record of close of business on March 9th, 2021. We achieved significant growth, generated capital at a rate where we're able to fully reinvest in our business and still have excess funds available to distribute to our shareholders. We will fund the special dividend from cash distributions of approximately $2.2 billion. Rocket is trying to incentivize the purchase of its shares to drive the price up. One of the ways they're doing it is by offering dividends of $1.11 per share. Do you want this dividend? All you have to do, seriously, all you have to do, buy Rocket shares by March 9th at the close of trading, and then you'll be included in this dividend payout, which is going to be paid out on March 23rd. They're actually shorted almost 40% of their float. A couple weeks ago, the CEO came out and said, you do not want to be short this company. I guarantee when he made that PR statement, they were already planning on this special dividend. What we should see here is Rocket shares absolutely shooting up between now and March 9th. And with this short position at 40%, there's actually a chance that these shares go way higher than they should be and detach themselves from fundamentals a little bit while the shorts cover. Another one I want to take a look at on here is PUBmatic. Now, PUBmatic just recently IPO'd back at the beginning of December. PUBmatic is another one of those ad marketplace companies like The Trade Desk, like Magnite, like Viant, like KBNT. PUBmatic is mostly the SSP side. So I guess the most similar comparison to it would be Magnite. Actually has incredibly low float, and that float is shorted at 80%. Now, they just released their earnings report, and their earnings report was a killer. If we check out FinViz right now, we can see PUBmatic has 47 million shares outstanding, but the float is only 5.8 million. And of that float, we've got this report here from the street saying 80% of that float, 80% of those 5 million is shorted. That's 4 million shares. Ooh. That's rough. Now, if we take a look at the PUBmatic chart, when that short article was published and also after the earnings, we can see the shares ended up just gapping up here. And keep in mind, this is on a red market, and we had the shares jumping up from $46 a share. At one point, we hit $75 a share, and now we're sitting at $64.81. PUBmatic had an incredibly good earnings report, and it's still shorted an absolutely nutty % of volume. There's a chance that this actually pushes higher in a short period of time. So as a risk-taking investor, PUBmatic is definitely something worth looking at. A lot of you guys probably invest in the ARK ETFs. The ARK ETFs had an absolutely brutal week. One of the things I want to mention is Cathie Wood's investment philosophy. In cases of a market downturn, she stated multiple times she wants to sell her stable stocks, her stable high market cap stocks, so she doesn't have to sell the smaller cap illiquid stocks at a loss, and she can actually add to those positions. Cathie Wood's ARK Invest added shares of Palantir, Twitter, and sold Apple and Facebook on Friday. Now, because of that philosophy, it makes sense that they unloaded Apple and Facebook and added what many people would think would be the riskier companies like Palantir and Twitter. On the 26th, on Friday, Shopify, Beam, Baidu, Twitter, Access, TDoc. Here's Palantir. This is 2.5 million shares of Palantir going into ARK.K. And here's another 867,000 1,000 shares of Palantir going into ARK-W. So they sold off the big stable stuff, ended up buying a lot of the smaller, more unstable stocks with higher potential returns. This is an aggressive strategy. ARK is an aggressive fund, and the risk reward payoff is why most people do invest in it. This is a big part of it though. If you're not happy with ARK selling off Apple and Facebook, you really need to kind of look in the mirror and understand why you invested in this fund in the first place. These are the risks that they're going to take. Let's take a quick look at earnings this week. Monday before open, we've got Workhorse. Brutal time to be a Workhorse investor. Workhorse lost out on the US Postal Service bid for the EV revamp of the entire US postal truck fleet to Oshkosh. By the way, also, there's a chance that Ford is going to be making the motors for the Oshkosh vehicles for the US Postal Service, so yay, Ford investment. But Workhorse is just dropping like a rock. Clover's been on the struggle bus for a really long time. I think it's had almost an entire month of losses. Target typically parallels Walmart, so this should be a good earnings report. With the bond sell-off, we might see a rise in some consumer staples like Dollar Tree and Costco. There's a semiconductor shortage right now, so Marvell might be reporting some pretty good revenue, some pretty good income. We have some smaller retails here: Kohl's, Nordstrom, Michaels, Abercrombie, American Eagle. Here's Turtle Beach. This is another one that's sort of like Corsair with peripherals, but Turtle Beach is much more limited than Corsair. They should be reporting some pretty good earnings though. And we've also got Smith & Wesson, which is a firearms and ammunition manufacturer. So let's take a look in Webull. Dollar Tree is one of those consumer staples, and if we kind of zoom out here, their last earnings report was absolutely nutty, and they ended up jumping from about $98 a share to $111 after reporting earnings, and they've been riding this high ever since. And just with this market downtrend, we've gone back down to $98. So we've basically undone everything that we did for the last 3 months since the last earnings report. I'm expecting Dollar Tree to have another beat, plus more money coming into it as people go into consumer staples with market instability. So Dollar Tree should see a pretty significant rise this week coming off earnings. Now, if we take a look at Costco, we can see they've been more or less falling for the last quarter. We're down here at $331 a share, and it's been a rough time here for Costco, losing about $25 a share just in the last week plus. If we look at their financials right here, we can see their last quarter was actually pretty damn good. They had a 38% year-on-year increase in income. Their revenue was up 16.6%, and they ended up just dropping off a cliff. We should have another positive earnings report for Costco, but I don't actually know what that means for the share price because of the way it behaved afterwards. That being said, because I'm expecting consumer staples to see an increase of money as people pull out of bonds and look for some kind of stability with potential return, I think Costco is going to be one of the beneficiaries of that. And after they show a good earnings, they should have a nice stock price rise this week. The last one I want to take a look at is Smith & Wesson. I found something very interesting, a correlation. So down here on Webull, we've got volume candles. The higher the candle, that means the higher the trading volume on a day. Let's just go back to the beginning of November. We have a big sell-off on November 4th. Oh, what coincided with November 4th? Biden leads in the Electoral College, but Trump claims victory. The US election was on Tuesday, November 3rd, so November 4th, we woke up, we saw Biden's Electoral College lead, and people had a massive sell-off of Smith & Wesson stock because in America, typically you think if a Democrat's in office, there's going to be more firearms regulations, so people did sell off at that point. Now, the next high volume day is going to be right after earnings on December 4th. They had a big earnings beat, so that makes sense that the stock price went up. December 15th was the ex-dividend day, so that's one reason for the rise. But if we take a look at the news on December 15th, we can see that's the day that the Electoral College made Biden's election win official. Now, you would think this would lead to another sell-off, but if you remember, there was a lot of unrest in America at this time because President Trump was fighting the election results and people thought that something terrible might happen. And so this actually led to piling on of Smith & Wesson stock and a big stock price increase. The next big candle we had, look at this huge green volume day, absolutely massive, and a huge run up in the price from $19 all the way up intraday to like almost $24 a share, closing out at $22.50. What happened on this day, January 6th? This was the 2021 storming of the US Capitol, happened on January 6th. So this is where the people ended up entering the Capitol with weapons. This directly led to a share increase of Smith & Wesson. So really, I expect Smith & Wesson to have another earnings beat because people do stock up on ammunition in times of unrest in America. I imagine the stock will rise. I thought it was really funny, the correlation between those high trading volume days on Smith & Wesson, and the share price. That's it for me today. Hope you guys enjoyed the video. I was not planning on doing a DD video this week, but I ended up doing one anyway because March 1st is a holiday in Korea. So you guys have the beginning of the Korean independence movement to thank for the DD video coming this week. It's going to be released at 9:45 a.m. Eastern Time Monday morning. As always, I want to thank you guys for supporting the channel. If you enjoyed the video, please like the video, subscribe to the channel. If you want to be alerted to all my content as soon as it goes live, hit that notification bell. Also, if you want to support my channel, please use my Webull referral link below the video. If you use that, you get a free stock, I get a free stock, everybody wins. All right, everybody, thanks a lot.